7 points of the Tax Cuts and Jobs Act every homeowner, prospective homeowner, and real estate investor should know. Hi, I'm Nate with Keyrenter. Wanted to create this quick video. As we know, yesterday was a big deal, December 20th, as Congress and the House passed the bill as it's currently written. A lot of things have changed over the last couple of weeks, even a lot of last-minute things. But there are a few highlights and a few things that impact homeowners and real estate in general that I wanted to talk about. Now, how this could impact you directly and individually, please talk with your accountant about that, as every situation is going to be a little bit different. But a few of the highlights I wanted to go over. The number one point is that the tax rate has been reduced, just in general, for general income. And so the new law provides generally lower tax rates for all individual tax filers, with different brackets being set up and established here, from 10 all the way through 37% as the highest tax bracket. And so how it impacts real estate is it retains the current rates on net capital gains. So for most filers, 15% capital gains, those in the highest tax bracket, 20% on capital gains, and then 25% on depreciation recapture. And the second point here is they wanted to remove cost removal or cost recovery or depreciation of real estate. That could have been a big deal. And so what happened actually is the final bill retains the current recovery periods of 39 years for non-residential, 27 and a half years for residential, so you can still depreciate your residential asset over 27 and a half years. And again, of course, talk to your accountant about how that impacts you specifically. Number 3, exclusion of gains on sale of a principal residence. So this is something that NAR and a lot of different housing groups were really trying to combat and push back on, because had this been changed, what they wanted to do was they wanted to change it so the amount of time a homeowner must live in their home to qualify for the capital gains exclusions was currently it's 2 of 5 years. They wanted to change it to 5 of 8 years. And you can imagine what that could do. So Congress is looking at this and thinking, okay, we could increase the revenue that we're receiving because people would be selling homes they hadn't lived in for 5 years. But really what would happen is we'd have people living in their homes much longer. Before deciding to sell after 3 years, they would have said, well, we need to stick it out another 2 years because we don't want to pay capital gains on our $100,000 gain on our real estate sale. And so we would have had less movement in the market, which could impact a lot of different things. And so the result of this, though, the final bill retains the current law, 2 of 5 years. So we're safe for now, and that's definitely a big win for homeowners and real estate in general. Number 4, mortgage interest deduction. So they wanted to change it from $1 million to $500,000 in interest that you could deduct. Now there was a compromise there where they actually changed it to $750,000 from $1 million. So still, there's a few compromises as you go through this bill where they wanted something they got somewhere in the middle. Number 5, state and local tax deductions that they wanted to get rid of completely. So the House and the Senate, they sought to eliminate the state and local income tax deduction. The result, though, is that both property tax and state and local income taxes remain deductible, but they put a cap on it of $10,000. Number 6, just a small detail, but important to some degree. So moving expense deductions, they wanted to get rid of completely. And what they ended up doing was the final bill repeals moving expense deductions for everyone except for those in the military. It's because military personnel are moving quite frequently, they still allow that to be a deduction on their taxes. And number 7, rental income subject to self-employment tax. So this would have been a huge deal to real estate investors to be subject to self-employment tax with their rental income. So the House enters the bill subject to income tax, self-employment tax, and so now what the result was that the provision was dropped from the House in the final bill, so it's not even on the docket anymore, which is a big win again for real estate investors, and hopefully you, as you're looking at that potential tax burden, and that could have had a dramatic impact with real estate investors in general. So when is this going to happen? So President Trump may be signing this before the new year. It's likely he's going to actually sign it in 2018 because of wanting to delay some of the because of Medicare and some of the other things that could be impacted, wanting to delay it until 2019. So we could see it before the new year, but everything that I'm seeing is showing that it's going to be he's going to wait till 2018. So we'll see. I think he'd like to sign it earlier, but we'll see what happens. All right. I hope this is helpful. Feel free to reach out if you have any questions. Talk to your accountant again. Read the bill if you really want an exciting read. And you take care. Thanks for watching.